Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings. Today, we're diving into Urban One's Form 10K for the past year. Don't worry, it won't be a dry financial lecture, even though we'll be looking at numbers that might normally put you to sleep. We'll see if this urban-oriented media company is really hitting the right notes or stuck on a bad frequency. Urban One targeting African American and urban consumers seems to be facing some challenges if the report is to be believed. From material weaknesses to strategic shifts and digital domain dynamics, let's decode this filing. First off, let's talk about the shares. As of late March of next year, they had about 6.5 million shares of Class A common stock outstanding and a whopping 34 million of Class D. Keep those numbers in mind as the stock's performance is very critical to the numbers being reported. Now, what's on the menu for today? We'll look at the usual suspects, their business, the risks they're facing, and of course those all-important financial statements. The first thing that jumps out, their net revenue is down almost 6% compared to the previous year. In a world where digital media is booming, that's a red flag. Now, digging into the numbers, we can see revenue from their radio advertising dropped by over $6 million. That said, political advertising, however, went through the roof. It increased by over 16 millions. I wonder what that means when election season ends. Speaking of segments, let's see what the segment revenue looks like. Their radio segment is 37%, reach media is only 10%, digital clocks in at 16%, and important to note that only a few markets like Atlanta and Washington DC account for much of this revenue, making them very dependent on just a few locations, not ideal. So what does this look like in actual numbers? Well, their radio advertising is down to $175 million. Digital advertising is also down. It's worth noting, however, that cable television advertising has also suffered a huge drop from $108 million to $90 million. Let's see if they are tightening the belt when it comes to cost. Corporate administrative expenses saw a decrease. Speaking of hits, impairment of goodwill and intangible assets, or their write-downs, went up to $151 million. Ouch, these are not cash expenses, but they definitely show that they are having a hard time to make their acquisitions grow. The company owes money and owing costs money. Their interest expense, however, did go down, and on the other hand, the gain on debt retirement went up significantly. So while business performance hasn't been stellar, it seems like they are doing okay in that aspect. However, this is contrasted by their other income dropping quite heavily. Of course, it's not all just about dollars and cents. Regulatory changes are always a headache in this sector. The FCC has a major say in who owns what in broadcasting, and those rules can seriously impact Urban One's ability to grow by buying up more stations. This can have adverse effects on their ability to make moves in the market. Oh, and like any company dealing with data, cybersecurity is a major concern. If they can't keep their system secure, it could mean losing customers, facing lawsuits, and a hit to their reputation. Okay, let's check the liquidity. Their cash and cash equivalents are nearly halved from 1 year ago, clocking in at $137 million. Not terrible, but definitely a downtrend. Diving a bit deeper, cash flow from operations is also down thanks to changes in accounts receivable and payables. This tells us less cash is coming in from everyday business. It seems they have used the funds to repurchase stock and retirement. A lot of those metrics are in the red for the period. One thing is that Nasdaq might delist them. This could make their stock tank and expose the company to lawsuits. Not good. It's worth knowing that they are a non-accelerated filer and smaller reporting company, which means less scrutiny. Here's a wrinkle. The CEO has a personal stake in TV1, potentially creating a conflict of interest. If TV1 does well, he profits directly. Also, a friendly reminder that the top two people in the firm, his mother and him, hold most of the voting power, so they can decide the direction of the company. It's probably not news that top executives are paid quite a lot. They are doing the basics with the audit committee, so that's good. It's also worth noting that they identify issues that might affect their finances. Here is an itemized list of PAVS, and itemol controls and issues related to the revision of previously issued consolidated financial statements. Out. Potential adverse impact for failure to meet the continued listing standards of Nasdaq's IMO. And potential adverse financial impact of volatility due to the current and future states of the global financial markets and the US economy. After volatility due to the current and future states of the global financial markets and the US economy. If they can't remediate material weakness, investors will lose confidence. Also, regulation can limit the number of radio stations they buy or own. Legal risks from content posted on their websites are also worth noting. As a result of the report delay with the SEC, they are not eligible to register the offer and sale of their securities using a short form registration statement. This means that any stock they wish to offer could get a lot more costly. Finally, general economic trends such as inflation could reduce ad spending. Lastly, a fun detail that this report highlights is that there has been an insider attack that the company is dealing with right now. They don't expect the breach to have a material impact though. Finally, let's not forget about the people steering the ship. The CIO and CISO have a lot of years in this industry. If you want to see any of these details for yourself, check out their website. Through now stepping back to get a broader sense of the situation, here's my quick takes. It seems clear to me is that Urban One needs to make some strategic moves to adapt to the changing media landscape. They're facing declining revenues, especially in cable television. It has also come to light their dependence of key markets, and this could mean some of their assets get written off again. And the company might not be able to take out debt. Despite the potential conflict of interest, having capable senior management and taking steps to fix existing material weaknesses can help make them stronger. The stock is worth keeping an eye on in the future. Alright, that's a wrap on our Corporate Decoder deep dive. Make sure you like, comment, and subscribe to learn more.